Okay, we're going to get started today by looking at the S&P 500. You can see that we're above all of the moving averages in the S&P. We have momentum. You can see the 20-day exponential moving average is a form of um, it's a guide for the S&P right now. And we haven't checked back to it yet, which means it's very powerful that um, move that we've had since the lows back here. So the reason why we do the look at the S&P as the first thing at every meeting is almost every stock in the stock market follows the S&P 500. So if you're investing in individual securities, it's a good idea to follow the S&P because chances are the stock that you're following is going to follow the S&P. So it looks like we have a lot of momentum in the market. Um, this is you can consider this move from the lows a thrust. In other words, it's a large move upwards in a short amount of time, and that's very powerful. So, but we are approaching. If we look at our meeting notes, we are approaching one of the worst months of the year. So let's look at our. Right now, we're at the end of May. And we're going into June. Look at that. June is traditionally it returns 0% over the past, 50 years. And we also have August and September as bad months in the stock market. So, but look at this. July is one of the better ones. And we have July 4th. And if we look at our calendar, okay, July 4th, a lot of times stock markets go up around the holidays. And July 4th is one of the most celebrated and well-known holidays in America. So we definitely look forward to that weekend as a very positive time in the stock market. But June traditionally is a poor month. So it's going to, well, we don't know what it's going to do, but we have two things that are going to affect it in June. We have the Fed meeting with the first meeting with the new Fed governor. That is going to be June 16th, 17th. And we have um, triple witching, which is options expiration. So it's going to be very volatile that day on June 19th. Okay, so now let's look at our talking points. The earnings for this week, we had NVIDIA report earnings. They were better than expected, and the stock market basically didn't it was a buy on the rumor, sell on the news, like I mentioned last week. So basically, even though the earnings were better than expected and the projections were better than expected, the stock sold off just because mm, there's a lot of talks of why it sold off. But last week we were predicting it's a buy on the rumor, sell on the news, and that's pretty much the explanation. Walmart produced a report that was not accepted by the Wall Street, and they projected weakness in the consumer. This is a example of a canary in the coal mine. So right now we have a lot of positive momentum in the economy and the stock market, but Walmart said the customers are kind of cutting back on some things. So that's just a hint that we're going to have problems with the economy. In the stock market, the Walmart, let's look at the Walmart chart. Hold on. You can see that Walmart went down substantially this week on that earnings report. Um, Walmart isn't a cheap stock. Walmart is very expensive. I did the estimates for Walmart. You can see that Walmart's only growing 12% per year, and it pays a very small dividend. The great thing about Walmart is they'll consistently earn between 10 and 12% over time. Right now, their PE ratio is 40. So with a PE ratio of 40, let's look at this. Walmart's PEG ratio, according to Yahoo Finance, is 4. That means it's 4 times overvalued. Um, I did the numbers, and it basically says it's 3 times overvalued. So any misstep or any clue that they're having some problems, and they're going to go down. I don't. This is a lot like Costco. Costco sells, it's overvalued. It's selling. It's only growing at 10%. Um, but I guess you pay a little bit more for a car that starts in the morning. That is the name of this. But right now it's very hard for me to buy a stock that's 4 times over, 3 or 4 times overvalued, and we have a possible consumer that's cutting back. Okay, that was a good excursion. Let's look at our other talking points. Okay, so this coming week we're going to have um, HP and Salesforce and Marvell report on Wednesday, and then we have Dell reporting on Thursday. All the other companies aren't really market moving or that important. Okay, so let's look at our numbers from last week. We have S&P up 1.3% from last week. We have 56% of the S&P above the 50-day, 56% above the 200-day. So we are gaining momentum in the market. Once this 56 number gets up to 70%, that means we are signaling a broad market strength. Right now, we have we don't have a lot of breadth in the market right now yet. So, and we're approaching some of the worst months of the year. So let's watch that. This S&P short range oscillator is let's look at that. It's oversold, and that is kind of opposite what the stochastics are telling us. So stochastics are telling us we're a bit overbought. And so when the S&P short range oscillator says we're oversold, that's a buy signal. But we also have a contrarian overbought situation in stochastics. So it's like we have no indications this week if we have conflicting um, statistics like that. Okay, so now let's look at, the S&P 500 chart. You can see that we're at the top end of the range. We're overbought in the stochastics. So, um, but we've been overbought for 2 months. So we've had a lot of momentum in the market. Um, any, let's look over, let's look at our formula. If we ever have an end of the war, and we're getting super close according to the headlines, if we ever have an end of the war, the price of oil decreases in a major way. And that means inflation decreases, the chances of rate cuts go up. And that means the stock markets will go up. Contrary to that, if the price of oil increases, we don't have an end of the war. Everything is the opposite. So we have a binary situation, and the stock market participants are just going back and forth between end of war or price oil increases, end of war. And we have these ridiculous headlines every day on Yahoo Finance. Look at this. Potential Iran deal after surging stocks. Potential, and then this fades into, oh no, Iran doesn't agree to anything. And then it's nothing. It's very confusing. Um, but for me, you have to ignore that noise when you're investing and look at the numbers and know what your stocks are worth that you're holding. Because geopolitical events, that they seem important, but in general, a lot of times they don't have a whole lot of effect on the stocks you're watching. So let's look at some of these headlines. Okay, Elon Musk has given up on solar power on Earth. Okay, we're going to have a IPO of SpaceX. That's coming out probably in June. That's pretty soon. So it seems as though Elon Musk is able to run multiple companies at once. The companies that he has started in the past, not all of them have been successful. There's been a solar city which was losing money. You had and there's a lot of companies that he hyped, and then he he bought that company out. And so this company, SpaceX, it's going to be interesting because it has a monopoly. Basically, they have 80% of the launches in the world every year. So they have a monopoly in launching satellites into orbit. They have um, basically the new space economy could be based on what they're doing with reusable rockets. So it's very exciting. As it gets closer to that IPO, we'll go over it. But for me, I would immediately put 0.5% of my money in on day one, 0.5% of 1%. So that's like 0.5%. And then just because I believe in Elon Musk. And a lot of times IPOs go up and down a lot in the first week or two of trading. And um, based on how the numbers turn out before the IPO, I would buy more or less. So let's see what happens there. All right, so let's look at some more of our talking points. Okay, look at the 10-year Treasury. In the past week, the uh, the yield of the 10-year has been going down. We have a promise of the end of the Iraq war. That will make the price of oil go down in a major way because if Iraq is allowed to sell oil, that is going to reduce and that's going to increase the supply around the world, and companies will be allowed to go through the Strait of Hormuz, which will increase the supply of oil in the world. So that'll make supply and demand means that the as the price of oil goes down, as the supply goes up, the price of oil goes down. And on top of that, inflation around the world will go down, and that will help the stock market. So we'll see what happens there. Um, okay, right now the price of oil. Um, let's see what the current price of oil is because it's changing all the time. Let's see, hold on. Look at this. The price of oil went down another 5% on this news story that the Iraq war could be ending soon. You can see the price of gold went up 1%. So high oil is inflationary, but it's disinflationary when it's going down. The inflation rate continues to be 3.8%. The reason why we look at inflation rate is your buying power as Americans go down 3.8% every year. So if you had $1 million 10 years ago, and this year it'll probably be worth 900,000 in buying power because of inflation. So that's why it's important to when you invest to put your money in something that you're getting back more than 3.8% or whatever the current inflation rate is. All right, the US dollar index, it's basically unchanged. So we have no comment on that. The price of gold is down 4%. And Okay, let's look at the fear and greed index. We are slightly less greedy than last week. Okay, so but we're still greedy. Um, the translation is whenever the market is greedy, you take some profits off the table or don't buy. And that kind of matches our overbought nature of our stochastics. Let's look at the bull bear, the AAII survey. We're bearish this week. So that's interesting. So if the amateur investor is bearish, it's time to start looking. So we have a lot of conflicting signals this week. So it basically cancels out each other, saying this is kind of a neutral time. If we get the end of the war, the stock market's going to take off. And other than that, we're in a neutral time. It's not a good time to put money in, or it's not a good time to sell anything. So we have a lot of contrary indicators this week. The VIX is low, meaning the stock market isn't expecting a big move down, and there's no one protecting. This is like a multi-year low. So that is a signal of a bull market. Okay, so right now we're greedy in the stock market. So mm, Warren Buffett would say whenever others are greedy, it's time to be fearful. And when others are fearful, it's time to be greedy. So right now, people are greedy. Let's look at some of the sector valuations. So the least valued sector is energy, financials, healthcare. They're not getting any respect this year. um, and if the price of oil goes down for the end of the war, this energy sector will get more inexpensive. And industrials, IT, and consumer staples continue to be selling at the highest valuations in the stock market. All right. So I like to look at this chart because um, as a contrary investor, I like to look for stocks, individual stocks in these sectors whenever they're out of favor. So if we ever see energies, financials, healthcare sectors, or utilities that are on sale, it might be a good time to start dollar costing into those. Okay. Um, let's look at the best sectors year to date. We have the energy sector up 31%, IT sector 18%, real estate up 11%, industrials, consumer staples, materials, and S&P is up 9%. And the worst sectors are financials and healthcare. It's interesting. Healthcare has been an underperformer for at least 5 years now. They've been at the low end of the performance. So when are they going to outperform? I don't know. Right now, the estimates, earnings estimates for the healthcare sector is going down, and so it's not a good real. I like to follow the earnings estimates, and earnings estimates are going up for the IT sector, and that's why I try to follow that. Okay, let's look at some of the stocks going up and down. We have sector market movers. Okay, we have Dell. They reported their earnings. Well, no, they're reporting their earnings next week. So they have a lot of AI servers that they're building, and and HP is actually reporting their earnings next week also. So it's going to be very interesting what happens when these companies actually report their earnings. And these are all stocks involving the AI data center build out. Um, we have Skyworks. They make the innards of cell phones, such as the modems and things like that. Um, we have Qualcomm. They make they're actually getting into AI data centers recently. They make chips, And so we have a chip AI theme in this top 10. And let's look at the top decliners. Okay, we have cryptocurrency, we have SanDisk, we have okay, so these stocks are they don't have anything in common. Okay, so Coinbase and Robinhood are both stocks that allow trading of cryptocurrencies. So a lot of times, whenever the cryptocurrency market goes down, they go down with it. And okay, so a lot of these companies, I don't see anything in common. Let's see what the sectors say. First of all, let's look at the 10-year. The 10-year, okay, let's look at the 10-year this week just to see okay, it's been going down. So if the 10-year goes down, what is our translation? Yields at the 10-year going down. It's positive for technology, small cap stocks, high yielding stocks. So if the 10-year yield goes down, any company that is a growth company that needs to borrow, growth company um, will do good because it costs less to borrow money to grow. It's negative for um, companies that need to borrow money. So let's see if this actually worked out. Hold on, sectors. Okay, so the sectors that did the best this um, is telecom. Telecom. So if the yields to the 10-year are going down, there's going to be a high demand for yield. That's why this telecom sector is going to be doing good because it's going to be hard to get a good yield when the interest rates are going down. Semiconductor is going up. Um, Mining, healthcare. Okay, healthcare pays a high dividend, so um, that makes sense. Technology sector, okay. Utilities pay a high dividend. So that follows a good portion of these top sectors are paying high dividends. And that's going to be really in demand when interest rates go down. Um, Gold miners, that's at the mercy of the price of gold. And same with oil. Oil is down because the price of oil is down. Okay, I would expect real estate to be doing better because as the yields go down in the 10-year, the demand for housing goes up. So, okay, so that's a good exercise. Okay, let's look at Google's current stock market narrative. I use Google AI every week just to find out what the narrative is on the stock market. So, in general, AI is earnings are powering records. So stocks are riding a hot earnings streak with more than 90% of S&P 500 firms reporting and showing robust growth, especially in AI-driven sectors. Okay, so that's why right now most of my investments are in AI and the big tech stocks, and that's why I continue to invest in those in that theme. The S&P 500 has been at record highs, driven by momentum in tech stocks. Okay, and the S&P 500 has extended its winning streak. So this so this chart that we see every week in the S&P, hold on, it's been at a winning streak for like 8 weeks in a row. So that is pretty powerful. Let's look at summer caution. We've been saying we've been saying that the June, August, September months are kind of bad on average. Let's see what Google AI says. Investors are cautious about potential volatility during the summer months, often slow period, especially warnings that historical data suggests a slowdown or correction might be due. So you got to be ready for that. You got to be ready for stock market volatility, seasonality wise, because the volume goes down in the summer because people are on vacation and there's not a lot of um, real news stories to get things going. Let me see. And on top of all these things, we have the SpaceX IPO, which could take money from other stocks. So people sell most of the time their winners and to fund the new IPO stocks that are hot. So watch out for that. And in summary, the market is existing a risk-on attitude supported by strong earnings, but is balancing this against the termite infestation of rising rates and inflation. Okay, keep that in mind. Okay, well, I like to review this risk on versus risk off. Um, Risk on, these sectors are going to be doing good. The communication services, IT, risk off, we have gold, silver, energy, materials, consumer staples, utilities, healthcare. So right now, this has been out of favor, the risk off. And since for the past 3 months, we've had risk on. I think my guess is towards summertime, we're going to have more of a risk off because if the stock market underperforms, we're going to have a demand for something consistent, and that could be what happens. Okay, let's look at some interesting charts that I found. Look at Google. Google has sold off and it's approaching its 20-day exponential moving average, which is the yellow line there. And you can see that we are oversold in the stochastics. So what are some catalysts that are coming up right now? We have um, Google owns around 7% of SpaceX. So if SpaceX turns out to be really good in June and it goes up a lot, then Google's going to benefit from that. So that's a good thing to keep in mind. And let me see. But you can see we have a wide range here. So in the summer months, Google very well could go down to the bottom end of this trend line. So you can see that it's been very consistent. And right now, we're like right in the middle and we have support at this 20-day exponential moving average. But you can see all of our moving averages are positive and um, most likely towards the summertime, we'll get down to the bottom end of this range. But it seems like it's a very good, um, if you're not invested in Google, it could be a good time to start dollar costing into it. Um, let's look at the next chart. Okay, this is Visa. Um, this is one of my favorite stocks. You can see it's been in a downtrend, and we know that from our chart of undervalued sectors that financials are one of the absolute undervalued sectors. A lot of this is the time I start looking for quality stocks in the financial sector because if I can buy and hold a stock um, forever, it's a good time to start looking for those whenever the sector is out of favor. So right now, almost all the financials are not doing that great. So I thought it'd be interesting to look at this one right now. You can see that Visa broke its downtrend, which has been in for over a year, right here, and it's starting an uptrend again. I've owned Visa since it IPO'd. That was like in what, 2010 or 2008 or something. And it's been growing at like 20% a year. Um, and it's forecasted to grow for around 20% a year. So this is like a core holding for me. And you can see it sold off along with MasterCard. It's a very similar chart. And MasterCard and Visa are growing around 20% a year. So, anyways, I thought that was an interesting chart. Let's look at NVIDIA. We were saying last week that NVIDIA, if it goes up into earnings, there's a very good chance it could sell off. And you could see that NVIDIA had better than expected earnings in their report. 80%, 85% growth of their earnings, and they had good forward estimates, yet they sold off. And they're down to their 20-day exponential moving average right now. The low end of their range in their trend chart is down here, and it very well could get down there towards the summertime. So we'll keep an eye on that one. Um, okay, I did a stock screen again. You can see Micron and GE Vernova stick out as some of my faves. Um, we'll go over Micron again, just because I like to review that every now and then. Okay, let's look at a report from Morningstar. 7 undervalued stocks that crushed Q1 earnings. I like to, Morningstar isn't that great of a research company. I like CFRA better than them, but sometimes they give some pretty good ideas. Um, for this report, I looked at every one of those. There are some problems with a good chunk of these. Number one, Fair Isaac. It's supposedly a wide moat. However, they just allowed, they had a monopoly in their FICO score for like a long time, and they raised their prices on their FICO score like 3,000% over how many years. And now they have something called a Vantage score that's possible competition to them. And so this wide moat is going to be like narrow very soon. So I would ignore this company right away. Um, so I thought it'd be interesting to go over Adient, just because I'm new to this sector. It's an auto parts dealer. They were spun off from Johnson Controls, I think, a while ago, and um, so I thought it'd be interesting to look at that. I looked at Amerisports. They basically sell sporting equipment in Europe. It didn't excite me, so I didn't go into it. I started looking into it, but it wasn't exciting. Okay, this is Amphenol, and I thought it has a wide economic moat. So I thought, hey, let's look at that one. So we're going to look at Adient and Amphenol. Okay, Adient, it's growing. I looked at their earnings projections. It's growing their earnings at 57%. And their PE ratio is only 9.72. So that means if you divide 9.72 by 57, it's 6 times undervalued. So just by the quick numbers, that matches what we see in Yahoo Finance. So that is a really good start. But when we look at the profit margin, it's almost zero. Look at that, 0.4% profitability. That is really bad. So immediately that's a red flag. And look at this total debt. They have 1.84 billion in debt. That is basically their market. That's more than their market cap. So that is super dangerous. So hold on for 1 second. Okay. So that is pretty dangerous. So I think just because of that, um, I'm not interested, because um, you have a problem with debt and you have a problem with the profit margin. Although it seems like it's 6 times undervalued, you have these are the fleas that come with this dog, and it's a little bit too much for me. So okay. And it's in an industry it's auto parts, which isn't that exciting to me. Okay, forget that one. They're based out of London. They were previously part of Johnson Controls. They spun them out. A lot of times when you spin out a company, there's a reason why you're spinning them out. They're not doing that great for your company. Okay, so let's look at what CFRA said. We already decided it's not a good one. They said the fair value is undervalued by 22%. Okay. But look at these earnings. It's negative plus positive, negative, 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 positive, negative, positive, barely positive, negative. That's that alone right there is not that great. Okay, let's ignore this one. Okay. Morningstar made the article, so they think it's about 1/3 of what it's worth. All right. And let's look at their chart just for kicks. It's sideways. It's not going up, it's sideways. So all in all, it's just a loser company. Let's avoid that one. Okay, Amphenol. This company is let's look at their statistics. Hold on for a second. Okay. You see it's growing at 17% per year. And if we look at their earnings projections, okay, so 17%, their forward PE is 26. So that means if it's growing at 17%, the PE ratio is 26. That means it's 1.5 times overvalued. It has a good profit margin and return on equity. And look at that, their debt, they have 14 billion of debt. That's pocket change for a larger market cap. And they have a positive free cash flow. So we did see APH Amphenol in some of the top holdings of our mutual funds. So that's why I thought it'd be interesting to look at this again. So, okay, they have a wide economic moat and they're 30% off according to Morningstar. Let's look at what CFRA said. They say that it's overvalued by 10%. And let's look at their earnings if they're going up in a straight line. That is what we want to see. Look at that. It's going up in a straight line. So that's really good without any negative quarters. So this is a decent company, but it's a little bit overvalued right now. According to Yahoo Finance, it's 13% overvalued. So I would have a tendency to wait for a market sell-off before I would start looking at this one. And you can see that it's in a sideways pattern. It's in a basing pattern right now. So this one isn't that exciting to me either. I like to look at stocks every now and then that we haven't looked at for a while. Let's look at Micron because Micron, every time we look at this stock, it's up another. It's growing. Last time we looked at it, it was growing at 350% for 27, 28. Now it's at 401%. So its PE ratio is still extremely low at 7.62. And right now it's growing at 401%, 401%. If you divide 7 PE by 401, that's a 0.2 PEG ratio. That means it's 5,000 times overvalued. That's pretty crazy. So that's amazing so Yahoo Finance thinks it's like 4 or 5 times undervalued. So the numbers are really good that we're looking for. That's 4 times what we're looking for. They have more cash than debt, and they have 3 billion in free cash flow, which is all super positive. And when I looked at this Wall Street Journal estimate page, we're gonna look at that from now on. You can see that we have a lot of buys. We have a high on the street of 1,100 price target, which is pretty amazing. And the average is where it's at right now. But you can see that right now we're we're in a little uptrend, but right now we have a new uptrend. This is the bottom end of the range of our new trend line. So let's look at what CFRA says. They said they're overvalued by 60%. So we have conflicting reports. Micron is riding AI pricing to Sami, but we expect the wave to crash longer term. So they think that this is a cyclical company that eventually everyone's going to be making this product and it'll reduce there'll be oversupply and everyone will have to reduce their prices. When that happens, no one knows. Okay, but they don't think it's going to go on forever. Let's look at CFRA again. As they say, our buy rating reflects valuation and our belief that the memory space grows through 27. Pricing should remain resilient, fueled by AI capex and HBM wafer capacity needs. Strategic customer agreements offer revenue visibility, while next-gen NVIDIA servers provide content growth. Micron claims high bandwidth memory for leaderships with 11 GPPS performance. A structural shift makes memory a strategic AI enabler, creating a durable upcycle. Its US-based position provides advantages amid trade dynamics. All right, and their fair valuation is 3,074. So they think it's undervalued by 309%. Last week, this number, fair value number, was 2,300. Now it's 3,000. That is outrageous. And let's look at their earnings. Very similar. It's inconsistent, very inconsistent. You have negative, positive, 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 negative, break even, positive. So it's riding the AI infrastructure wave. And so let's divide the current price, which is 3,000. Let's get this number again. 3,073 divided by, I think it's 750. It's 4 times undervalued according to CFRA. So that's interesting. All right. So let's look at another stock that we've been following, Western Digital. According to their statistics, they're growing from this year to next year at 72%. And if they're growing at 72, the PE ratio now is 25. So the PEG ratio is 0.34. So it's 1/3 the price of fair value. The numbers for profit, margin, operating, these are excellent. Return equity is 85. That's like 5 times what we're looking for. And profit margin is 3 or 4 times what we're looking for. Total cash, they have more cash than debt. That checks okay. And they're making $2 billion a year. So this is a very high quality company. And let's look what the CFRA said. They're more reliable than Morningstar. They said they have a buy rating with a price target of 532. They said the buy reflects Western Digital's favorable price positioning to capitalize on AI-led data storage demand, which we see as structural multi-year tailwind. Western Digital's transformation into a focused HDD pure play enables sharper execution following the spinoff, while leverage has come down significantly. They spun off SanDisk. Okay, so robust near-demand margin expansion and secure multi-year contracts through 2029 position Western Digital for sustained growth above 25%, with the company continuing to execute roadmap and bring higher capacity to customers. Okay, so they have a the CFRA has a fair value of 755, and they're undervalued by 56%. they have a very similar situation where they have some negative quarters, some positive, so it's very inconsistent earnings. Morningstar says they're overvalued by 16%, and they say they have a blowout quarter. Third quarter revenue grew 45%. The company beat its own guidance, and they are wondering about the durability of those earnings. How consistent and how reliable are those? That's why they have a fair value of 0.16% overvalued. All right, so let's look at Western Digital's. They have a very similar chart to the Micron, um, in that it's gone up a lot since April. Um, and it's kind of at the low end of its range right now. Look at that. It's oversold and it's at the bottom end of its trend line. All right. Hope you enjoyed that talk. That's all I have to say for today. I hope you enjoyed it, and I'll see you next time.